So private equity is investing in a private company or investing in a public company and bringing that public company private. An example of that is in October 2013, there was a management buyout where Michael Dell combined with the private equity company Silver Lake Partners, and they bought Dell off the stock market for $24.9 billion and brought the company private. Technically, by definition, venture capital would be a subset of private equity. But here in North America, we look at private equity and venture capital as two distinct things. The course we have here at the University of Waterloo is private equity and venture capital, where private equity represents mostly buyouts, which is investments in larger, more mature companies that use significant amount of debt, where venture capital is investments in smaller companies, younger companies, and they use little or no debt. So there's buyouts, there's venture capital, but there's one more in between, and that's called growth capital. Growth capital are minority investments that are usually made in more mature companies. So you kind of classify it more as private equity, but it could also be classified as venture capital. For example, Georgian Partners, they invest minority stakes in growing companies that have revenues between 10 and 80 million. And Georgian is referred to as a late stage VC. So we've looked at buyouts, growth capital, and venture capital. Let's look at a detailed example of buyouts. So let's say we buy a business for $40 million that has $5 million in EBITDA. And let's say the bank will give us 4 times EBITDA, so 4 times $5 million, that's a $20 million loan, at 5% interest rate. 5% of $20 million, we're all good at math, that's $1 million a year. So let's look at the difference between doing this deal without leverage or with leverage. So without leverage, we're paying $40 million for $5 million in EBITDA. That's a 12.5% return. But with leverage, we're only paying $20 million because the bank's paying the other 20, and we're not getting $5 million because we still have to pay that $1 million in interest, so we're getting $4 million. We're getting your $4 million on your 20, and that's a 20% return. So by adding leverage to this deal, we're increasing the return from 12.5% to 20%. That's a simple example of how a leverage buyout works.